Hello and welcome to Portfolio Matters. In today's episode of My Worst Trade, I'll be talking about my worst trade of the last couple of the years, which lost me the most money essentially in the past cycle. And that is a company we did for Share Talk. So this is quite a recent issue and it's James Fisher and Sons. Now, we won't be doing a disclaimer because we're not recommending any shares, but as always, do your own research. Okay, so the conclusions. This is not a simple my worst trade. Actually, I've sat down and thought about all the things I got wrong. And actually, I think there are quite a few takeaways. It's not just one thing I got wrong. It was a whole confluence of problems that led me to overweighting this company in my portfolio, and hence it lost me more money than it should have done. So the first and biggest takeaway is trade close to the source of your investment idea. So if you think oil is going up, trade companies that are directly exposed to the oil price. The further away they are from the source of your investment idea, the more tangential it becomes. So James Fisher was a diversified maritime company with a lot of exposure to oil companies, but then you're talking about quite a complex chain to get increased revenues to James Fisher, and it's only partly exposed to the oil cycle. The rest of it was exposed to maritime trade, which I also expected it to pick up. But the bottom line is that I was expecting a big pickup in oil industry capital spending, which would feed through to James Fisher, and that never arrived. And so James Fisher's revenues failed to pick up. Second takeaway, beware turnaround situations. Now, frankly, I like buying shares with big upside potential. And so I'm drawn to these value traps where the share price used to be much higher previously and has collapsed. And you think, well, if the share price can get back to where it was, then you're going to double, treble your money. And that was what I was thinking about James Fisher. But the lessons I've learned over the last couple of years are that actually these turnarounds take longer and more capital than you expect. There's already a lot of optimism in the price about the turnaround, and don't buy the shares until there's some sign of progress. And if we think about the turnaround situations that I bought last time, I'm talking about Tecmar, James Fisher, Rambler, Metals and Mining, none of them worked. Of those, Rambler was the best. Tecmar and James Fisher were both total disasters. Now, one thing that I was aware of but failed to emphasize in my original analysis was this was a low margin business. And low margin businesses basically just don't have enough underlying profitability to allow them to withstand unexpected setbacks. In this turnaround situation, it's made more difficult by the fact that even in the good times, it's not strongly profitable.
Can I just chip in on your conclusions, Keith? I know we haven't yet told people the detail of your trade, but I think it's really interesting. So in my experience, which is limited clearly, but making changes in a business always takes longer than you anticipate. But the directors are always incentivized to make the process appear easy. And that's not to say that they are actually dishonest. It's just that if they weren't optimistic about it, they may well move on to somewhere else. It's their role is to be optimistic and to see the upside. The second issue, I think, is that turnaround situations can be very profitable. But as you rightly say, it's timing the turnaround. And My view is, and I'm not a chartist, but my view is that the way to play a turnaround ideally is to wait until the price has broken through some form of resistance, and a large number of investors feel that the turnaround is underway and it's a much safer place to be. And I'm minded of the aphorism that losers buy losers and winners sell losers. And the problem with the turnaround situation is if you buy too soon, you're buying it when it is a loser. And the question is, how do you identify the point at which it becomes a winner? And you always give away, by waiting, you always give away some potential profit, but you don't expose yourself to buying much too soon.
Thank you, Richard. I think your point about the optimism of management is crucial, actually, because when I think about all three of those turnaround situations, management were just relentlessly optimistic that it could turn around, in particular, Rambler. So moving on, the other thing is diversified service companies, Tecmar, James Fisher. You know, they're essentially a conglomeration of small businesses, which, you know, did they have any business being together, really? There seemed to be a fundamental problem in managing these businesses, which were disparate. Yeah. And once again, Richard's point, sell your losers. I mean, the thing is, the reality is this trade never worked. And I hung on in the belief it would, but if I just sold it when it was down 20%, I would have saved myself a lot of money.
And the huge temptation is that it's down, so you buy more because it's a good idea, or you wouldn't have bought it. So you buy more when it's down, and then you sell your winners because...
yeah. Well, I've got better running my winners.
I don't know why.
Yeah. Well, you think they can't keep on going up, actually.
Exactly, yeah.
But I have got much better at running the winners, frankly.
Good, well done.
I have yet to get over buying the losers, sadly.
Give it time, Keith.
Yeah, but the fundamental problem was I confused what sort of company James Fisher was. So, and we will go into this, in that I buy cyclical oil companies. And because I play the oil cycle, and you can't ever time a cycle right, as oil companies fall further, and I'm confident that the oil price will rise at some stage, I buy more. And actually that works. And so I was thinking James Fisher, well, is just exposed the oil cycle. At some stage, CapEx will return and I'll simply buy more. And when the turn comes, it will pick up. But actually, it wasn't a cyclical oil story. It was a fundamental turnaround story.
Yeah.
And so I shouldn't have bought more. So in summary, trade close to the source of your investment idea, buy stocks that are directly exposed to the asset or commodity or the idea that you want exposure to. The further away they are, the less pure your trade is. Beware of turnaround situations. Wait until there is evidence of a turnaround. And by that, we don't mean management is increasingly confident, because they're always confident. Avoid low margin businesses, and I will be very aware of that in future. And finally, beware false diversification. The reason I had quite a large position was I thought, well, I've got loads of oil. This is kind of half oil. You know, I should have a load of this as kind of diversification. The reality is my core oil idea was really good. This idea was a bit rubbish. And so putting a load of money in this, you know, did diversify by losing money. Anyway, so going back to our original share talk, why did I like this company in the first place? So this is the share price chart, and you'll see that in 2019, 2020, it was trading at around £20, and during the COVID crisis, it fell to around £8, bounced back. And when we did our share talk, it was about £10. So in my mind, I was thinking, if everything returns to its pre-COVID normality, shares could double. Looks good. And this is our original conclusions, describing it as an acquisitive marine support services company and highlighting the fact it had invested in 2 dive support vessels at the wrong time and had to impair them. But essentially, the bottom line was it didn't really seem to have good control or good management of the businesses. We were aware of that. But it was heavily exposed to the oil and gas sector, and I thought that as oil and gas capex rose, that it would recover. But I also highlighted that it had been unable to transform revenue growth into earnings growth, i.e., its margins weren't great. Now, this is the original table of the earnings. And I highlighted how in 2020, revenues were only down 16%, which is actually quite a creditable outcome. And operating cash flow had held up. What I didn't highlight was the operating margin. See, even in the good times, the operating margin wasn't great, 10%. And I'd also highlight the fact that earnings were due to recover in 2021 and 2022, and is forecast to pay a dividend. The outcome, sadly, was not that. So the positives, if you're interested, pause and take a look. But ultimately, it came down to the fact that previously this had been a decently valued company. And I thought that with the recovery in the maritime trade and the oil and gas services sector, that the share price would get back to its pre-COVID levels. So I thought there was at least 100% upside. Now, the negatives, one thing, it was highly indebted. It had invested in these dive support vessels, and then it was promptly selling them. And it seemed like extraordinary to me that they'd invested in them and then they were selling them at the first opportunity. And they were undergoing a restructuring. They got lots of different businesses, and even after halving, the shares were on a P ratio of 16. So were the shares just overvalued previously? Note that I did not highlight the relatively low margins, and I should have done. So to understand why I put so much money in James Fisher, you have to understand my investment strategy. So one of the things I play is the oil cycle. And the reason I play it is the oil cycle is highly volatile and predictable on a medium to long-term view, not on a daily or weekly view. I think that's impossible, but it's highly cyclical over years. And so I invest in companies that I expect to benefit from the rise in the oil price, and I try and time the cycle. And the reason I like this game is it means you shouldn't have to deeply analyze a lot of oil companies. As long as they've got production, then you can do some light analysis, but if they're exposed to the oil price, their share price will go up. And then you can play the game of which ones in my portfolio are doing well. I'll buy those and I'll sell the losers. And that also works. And this is how it should work. And this is actually what I have done. So after the great financial crisis, I bought a load of oil companies and I sold them prematurely, but having made a very good profit. I then bought again in 2015. I slightly messed it up actually in 2018 in that, and I have done a my worst trade on this. I was aiming to get out here and I missed the peak and got out here, but still, it was a good trade. And the post-COVID cycle has been great. I bought early, but then I rode it through and have exited for a very good profit. So that is the idea. And you can see how it works with Shell. So these are all my trades in Shell. Shell was trading at £26 pre-COVID. Then as it fell, I started buying at £13.30. And we talk about not adding to your losers. Well, because it's a highly cyclical business, I do. So I buy at £13.30. I bought more as it went down. Last trade was bought at £9.30. And at that point, I was down 30%. So, if you play this game, you have to be willing to take quite a lot of losses. And then it recovered quickly and then it drifted off. But I didn't sell. I kept on buying. And I've sold the whole lot at £24. And this is Hunting PLC, which is an oil service company. And I attempted to play the same game, but the bottom line is this CapEx didn't return this cycle. And so in 2018, Hunting, which I really like, is a very high quality business, its share price was £9. During COVID, it collapsed to £1.50. And I started buying it. And then in the course of the following year, it did nothing and drifted off. And then suddenly this year, on hope, the shares really picked up and I sold the whole lot at £3.09 on average. And I'm completely out. And actually, I made 40% return, I think. But you'll see in the last few days, the shares have collapsed again because the bottom line is every quarter when it reports its results, the results are disappointing. The market has been anticipating an upturn in CapEx, which just refuses to come. Okay, so with that in mind, what was my plan with James Fisher? Well, I was very much looking at the doubling potential of James Fisher. And frankly, I was hoping rather than analyzing, I think. So I was looking for 100% upside. And I thought there'd be an increase in trade. As the supply chain difficulties eased, I thought, it's heavily exposed to maritime trade, big pickup in trade around the world, should be good for the business. And it was a well-established business with a long history. But what I didn't focus enough attention on was the fact it was an unfocused conglomerate with poor margins and it invested in the wrong segments at the wrong time prior to the pandemic, which suggested a lack of managerial control. And it was in the process of a turnaround plan, which I was aware of. But as always, management were very optimistic. Bottom line, I bought too much. So what happened? Well, this is oil CapEx. The dotted line is the oil price. And you would hope that as the oil price rose, oil company profitability rises, they invest in future production. And that is the historic pattern. This time, it didn't happen. And so there was no pickup in revenues for James Fisher. So every time it reported results, it was a profits warning. And if we look at the actual outcome, you'll see that when we did our share talk, the market was expecting revenue growth in 2021 and a decent dividend. The actual outcome was revenues fell on the year, it lost money, and it paid no dividend. And cash fell over the course of the year. So results were very disappointing. So my trades, well, when we did our share talk, I established a position. And then as it drifted off, I bought more because I thought it was a cyclical play. And then after the first profits warning, I thought, oh, God, this is so cheap now. Any good news, just send the shares flying. And there was a period prior to the results when it looked like that was working. And actually, my break even was somewhere like £7.50. And for a brief moment, I thought I might get there. Then we had the results, disaster. I read the results. The results were relentlessly negative. There was no positive information in there at all. And I sold. I sold the whole lot that day. So average buy price, £7.85. I sold everything at £3.76 for a loss of 52%. And because I'd overweighted the stock in my portfolio, that was a loss of around 2%. So in summary, the lessons from this, my worst trade, are number one, trade close to the source of your investment idea. Beware turnaround situations. Avoid low margin businesses. Beware false diversification. And finally, don't add to your losers. Richard, what are your thoughts?
Yeah, well, thank you very much for sharing that with us, Keith. It's very interesting. And I think the before and after analysis is very interesting. I also think there's one other point that is important to make, which is quite nebulous, which is beware a change in behavior. So you made the assumption, not foolishly at all, that the oil price goes up, oil companies will invest more in exploration and development. And that was a false assumption. Yeah. But it's perfectly reasonable at the time. And so I personally suspect now that that it's a false assumption until the world weans itself off oil. Although at the time you did the James Fisher share talk, I agreed with you. I thought you were right. But the dynamic within the fossil fuel sector has entirely changed. And I don't think oil companies are any more prepared to invest in exploration because they see it as fun money spent that they will get no return on, as well as giving them a great deal of angst in terms of ESG. But of course, if I'm right there, that means the oil price will continue to rise as exploration and development slows further and further, which means that in due course, there may well be an opportunity to buy back into oil producers, i.e. close to the source of your investment thesis. So I think I actually think you were caught by a change in the way the world views exploration and development, Keith, as well.
Yeah.
And the points that you make aggravated the dilemma you got caught in. So as you know, my view is that precious metals are a stable source of value in a world which is becoming increasingly uncertain and increasingly difficult to understand what's going on. And I'm very aware of the fact that I may be wrong in that. And one of the things that George Soros always said was seek out people with an alternative point of view. And I think now more than ever, that is so important because the world is so difficult to understand and so difficult to predict that trying to make these decisions on one's own is really, really hard.
Yeah, no, absolutely. I completely agree with you, Richard. And I will be looking to buy close to my source, i.e. oil companies, at the bottom of the coming cycle, because I think it's going to bottom again.
Yeah. And just out of curiosity, do you think it's going to bottom relatively soon or in quite a long time?
I think we're going to have a recession in the second half of the year. And it could be really bad, frankly. The speed with which interest rates have risen. Whenever interest rates rise that quickly, something breaks. We don't know what it's going to be this time. And it very much depends on what the fallout is. And, I think, one thing you've taught me, Richard, is, is to do some technical analysis and not try and time it. Just wait for it to bottom, really. Trying to buy a falling knife. Every time I've tried it, I've lost a few fingers. So,
and that's because people know, there are a few people who know why it's falling, and they don't tell you, but their actions speak louder than words.
But also, I think there's just a fundamental lack of liquidity. And when you try and say, oh, it's hit my fair value target, people are selling for panic, and there's no liquidity, and it just keeps on going.
Yeah, I completely agree.
And so, you know, if you think about Shell, I thought, you know, buying it £13.50, a total bargain, which it was, but it then fell a further 30%. If I'd bought it all at, you know, 30% below that, I'd be looking even better. So, you know.
It's very, very difficult, isn't it? And I think the watchword is caution. And I think that we have to be very, very careful about the assumptions we make about where the world is going at the moment. Really careful.
Absolutely.
Well, I would say that's very interesting, Keith. And I think very thought-provoking in terms of the markets as they currently are. So thank you.
Great. Well, thank you, Richard. Enjoy the rest of your holiday. Thanks for dialing in. So thank you all for watching. Please, can you press like and subscribe to the channel? And it's goodbye from sunny France, from Richard Wheaton.
Sunny France. Or thunderstormy France, as it happens, but hopefully sunny tomorrow. Goodbye, everybody. And it's goodbye from less sunny London, or maybe more sunny London.
No, less sunny London, actually. Bye, everyone.
Bye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.